One of the key questions, and these are things I say we must be debating and discussing today, and hopefully Neil Day, Euroweek, the cover, who's with us, will be reporting and writing about as we in the coming weeks. The key question was what happened to all of the liquidity that the covered bond market had once promised. Another question is covered bonds as an agency surrogate. Was this just so much marketing myth? And did a so-called rates product run or turn out to be a credit product instead? One of the gentlemen I met just over breakfast here was saying that he was surprised by that debate, by that question. It wasn't clear that we had tried to position it as a rates product rather than a credit product. And I think it's worth reigniting that debate and looking once more to see what is the nature of the covered bond, how have we positioned it, and how do we position it going forwards. And how did the covered bonds succumb to the credit crunch, which seemed to sweep aside every single asset class across the global capital markets? And does it make much sense to go on pushing the covered bond idea? The market is beset by doubts, but let me make a few further observations. Spreads in the market did widen, but the repricing process is well underway. And again, I think there will be hopefully a lot of debate about that later today. A tightly priced asset class has fractured into a number of distinct geographical curves, which also presents us with particular problems for what was earlier, prior to the dislocation, seen as very distinct, homogeneous asset class and market. And we can't ignore the fact that we now have greater distinction between asset classes, however unwelcome that may be. And the secondary market, we observe, did not withstand fully the collapse in investor demand and activity over the summer any more than it withstood it in other asset classes. We also observe that there is a distinct tiering between the public sector and the mortgage-backed covered bonds, something we always probably anticipated, but which has been exacerbated and magnified in recent months. But although the sentiment has been negative, there have been positive signs in the form of issues and activities, transactions. Investors in Europe have returned, and deals in Europe at least are getting done. Bank of Scotland's successful transaction only last week, Eddie Foncier's successful series of transactions raises significant volumes in these difficult markets. Many of the borrowers here today, the Royal Bank of Canada only this morning in Europe, all of them have very successfully raised funds in these troubled waters. And of course, there's another observation: with the significant divergence of spreads between asset-backed securities and covered bond markets, investors may finally accept, and this is a comment I aim at the US investor market in particular, that though the two products are closely related in certain structural respects, they are not, as we might say, joined at the hip. They are distinct and very different. And I think the dislocation of these markets has demonstrated that quite clearly, and I'm sure there will be some debate on that issue later on as well. Turning for a moment to the US investors, which are key to the proper globalization of the asset class, and something that we, all of us in the industry, hope to see, and we obviously want to take measures to attract the US investors back into this asset class. I think several disappointments can be identified. The things that didn't work out as we might have hoped in an asset class which only just started to take root in the US, be it issues by the US banks themselves into this market or from Europeans coming over. And a number of issues which again we should debate later today: the lack of liquidity, the lack of the repo, poor financing terms for those who buy on a leverage basis, and also some ambiguity now over where the product trades and how it trades.